If you are working in the UK right now, there are 3 changes to the state pension that happened in 2026 that most people either do not know about or do not fully understand. And depending on your age and your situation at least, one of them will directly affect when you can retire, how much money you will receive, and whether that money will actually be enough to live on. Today, we are going to break down every single change in plain English, what the numbers actually mean in real life, and most importantly, what you need to do right now, because the gap between people who understand this and people who ignore it is the difference between a retirement you can actually enjoy and one you spend worrying about money every single week. Let's start with the good news, because there is some, and it is genuinely meaningful. From the 1st of April 2026, the full new state pension increased by 4.8% under the government's triple lock. Guarantee the new weekly rate for 2026 to 2027 is £241.30 per week, which works out to £12,548 per year. That is up from £230.25 per week in the previous year, meaning pensioners on the full new state pension are receiving an extra £11.05 every single week, or an additional £575 over the course of the year. And that 4.8% increase was the highest of the 3 triple lock measures, because average earnings growth over the May to July 2025 period came in at 4.8%, which outpaced September 2025 CPI inflation of 3.8% and comfortably cleared the 2.5% floor. So in the battle between wages, inflation and 2.5% wages won, and pensioners benefited. Now, let's make sure everyone understands what the triple lock actually is, because it is the single most important protection the state pension has, and it is also the thing most at risk in the long run. The triple lock is a government commitment first introduced in 2011, which guarantees that the state pension will rise every April by whichever of 3 measures is highest in that given year. The first measure is average earnings growth, the second is CPI inflation, and the third is 2.5%. Regardless of what the other 2 do, the logic behind it is to ensure that pensioners are never left behind, either by a rising cost of living or by rising wages. In the working population and over the past decade, it has been extraordinarily effective at protecting pensioner incomes in real terms, but it comes at a cost. The Office for Budget Responsibility has calculated that the triple lock costs the government approximately £0.5 billion per year, and that figure is set to rise sharply as the UK population ages, which is exactly why the triple lock itself is being increasingly questioned. And we will come back to that, because it matters enormously for anyone currently under 50. But first, let's talk about what the new rate of £241.30 per week actually buys you in 2026. Because this is where the numbers get uncomfortable and where most conversations about the state pension stop short of telling you the truth. £12,548 per year sounds like a reasonable income until you hold it next to what it actually costs to live a decent life in retirement in the UK. The Pensions and Lifetime Savings Association, which is the gold standard body for retirement income research in this country, publishes annual benchmarks called the Retirement Living Standards. And for 2026, they look like this for a single person living outside London. A minimum retirement which covers all your basic needs, but with very little room for anything beyond the essentials, costs £14,400 per year. A moderate retirement, which allows for 1 foreign holiday per year, occasional meals out and a reasonable social life, costs £31,700 per year, and a comfortable retirement which includes 2 foreign holidays, a newer car, regular leisure spending and some financial gifts to family, costs £43,100 per year. Now, look at those numbers again. The full new state pension of £12,548 does not even cover the minimum living standard of £14,400. For a single person, it falls short by £1,852 a year. And if a moderate lifestyle is your target, The gap between what the state pension provides and what you actually need is £19,152 per year. That is nearly £20,000 per year that the state pension does not cover. And that gap has to come from somewhere. It has to come from your workplace pension, your private savings, your ISA, your investments, or some combination of all of them. And the brutal reality, according to the DWP's own analysis published in 2025, is that 43% of working-age people in the UK, which is approximately 14.6 million people, are currently undersaving against the income they will need in retirement, not slightly undersaving, dramatically undersaving. And here is the number that makes that clearest. The average pension pot for someone approaching retirement in the UK right now is approximately £107,000 in defined contribution savings using a sustainable 4% annual withdrawal rate. That £107,000 pot generates around £4,280 per year in private pension income. Add the full state pension and you are looking at a total retirement income of approximately £16,748 per year, which just barely clears the PLSA minimum standard and sits less than half of what you would need for a moderate retirement. This is not a peripheral problem affecting a small minority. It is the central financial reality facing the majority of working people in this country. Now let's talk about the second major change, because it directly affects when you can actually start receiving the state pension, and this one is catching millions of people completely off guard. The state pension age is rising from 66 to 67, and the increase began on the 6th of May 2026. It will be phased in gradually, meaning that your exact date of birth determines exactly when your pension age transitions from 66 to 67. If you were born between the 6th of April 1960 and the 5th of April 1977. This change directly affects you, and depending on your birth date, you may find that you have to wait months longer than you expected to claim your state pension. The phase-in is not instant. It works through a sliding scale tied to your date of birth, so someone born in June 1960 might find their state pension age shifts by just a few weeks, while someone born later in that window faces a longer delay. And here is the financial impact of that delay. In concrete terms, the full new state pension pays £12,548 per year. Every year you wait to receive, it is £12,548 you do not receive. So, if the state pension age rises by 1 full year and you had planned to retire at 66, you face a choice. Either you retire as planned and fund that additional year entirely from your own savings, or you continue working until 67 and claim the state pension on schedule. And for many people, particularly those in physically demanding jobs or those with health challenges, that is not a real choice at all. But this age 67 milestone is not the end of the road. And this is the part most people in their 30s and 40s are completely unprepared for. The government's current legislation already plans to raise the state pension age again from 67 to 68 between the years 2044 and 2046. But here is what the fine print says. The government is actively considering bringing that 68 transition forward to as early as 2037 to 2039, which would affect anyone currently in their 40s. And more alarming still, the International Longevity Center has published research suggesting that based on current demographic trends and the financial sustainability of the state pension system, the retirement age for people born after April 1970 may ultimately need to rise to 71 to keep the system solvent. That is not a fringe view. It is a serious analysis from one of the UK's leading demographic research organisations, and it tells you something very clear. If you are under 50 today, you cannot plan your retirement around the assumption that the state pension will be available to you at 66, 67, or even 68. It may not be. And that leads directly to the third change, and this one is the most important for your long-term financial future. Because while the first two changes are things happening to you, this one is something you can actually do something about. And that is the change to the state pension age combined with rising longevity means that your private pension, your workplace pension, and your own savings now need to do an even heavier lift than the generation before you. The rules around pension contributions in the UK remain genuinely generous for those who understand them and use them. The annual allowance for pension contributions is £60,000 per year, and contributions into your pension attract tax relief at your marginal rate, meaning a basic rate taxpayer, gets 20% tax relief. On every pound they contribute, a higher rate taxpayer gets 40%, and an additional rate taxpayer gets 45%. This means that for every £80 a basic rate taxpayer puts into their pension, the government effectively tops it up to £100. For a higher rate taxpayer, every £60 effectively becomes £100. And for an additional rate taxpayer, every £55 becomes £100. These are not small numbers, and they represent one of the last remaining genuinely generous tax incentives in the UK tax code. The auto-enrolment system means that most employed people in the UK are already making pension contributions, but the minimum auto-enrolment contribution of 8% of qualifying earnings between £6,240 and £50,270 per year is almost certainly not enough to bridge the gap to a moderate retirement income. The research is consistent on this point. Most financial planners and the Pensions and Lifetime Savings Association both recommend targeting total contributions of 12 to 15% of your total salary, not just qualifying earnings, and not just the employer minimum. If you are only contributing the minimum under auto enrollment and your employer is only contributing the minimum, you are very likely to reach retirement with a significant shortfall. So, what should you actually do with all of this information? And this is the part that matters most, because the changes to the state pension are not going to reverse themselves. The age is going up. The real value of what it provides relative to what retirement costs is not going up fast enough, and the long-term sustainability of the triple lock is being increasingly questioned by serious policy analysts. The right response is not panic. It is a clear and specific set of actions. First, check your state pension forecast right now. Go to your government gateway account and look at your national insurance record. You want to see how many qualifying years you already have and whether there are any gaps you need to fill. You need 35 qualifying years for the full new state pension, and you need at least 10 qualifying years to receive any state pension at all. If you have gaps in your record from years when you did not work, did not pay enough national insurance, or were not credited for contributions, you can potentially fill those gaps by making voluntary national insurance contributions, and in many cases the cost of filling a gap is significantly less than the lifetime value of the extra state pension income it generates. For some people, paying a few £100s to buy a missing national insurance year can translate into hundreds of pounds of additional state pension income every year for the rest of their life, which over a 20-year retirement is an extraordinary return on investment. Second, work out your retirement income target using the PLSA Retirement Living Standards as your benchmark. Decide whether you are aiming for a minimum moderate or comfortable retirement, and then calculate the gap between what the state pension will provide and what you actually need. Once you know the gap, you can work backwards to understand how large a private pension pot you need and how much you need to be contributing each month to get there. A rough rule of thumb for a moderate single retirement outside London is that in addition to the full state pension, you need a private pension pot of approximately £375,000 if you are planning to draw it down at 4% per year. And if you want a comfortable retirement, that number rises to approximately £600,000. Third, review your workplace pension contributions and check whether you are getting the maximum employer contribution that your employer is required to offer. If your employer offers to match contributions above the auto-enrollment minimum and you are not taking that up, you are effectively turning down free money. That is one of the most costly financial mistakes you can make, because your employer's contribution is part of your total compensation, and declining it does not. If give you the money in cash, it simply means neither you nor your employer contributes it, and the long-run compounding value of that missed contribution is enormous. Fourth, consider whether a stocks and shares ISA alongside your pension makes sense for your situation. An ISA allows you to save or invest up to £20,000 per year in a wrapper where growth and income are tax-free, and crucially, you can access ISA money at any time, unlike pension money which is generally locked until the age of 57. For most people, running both a pension and an ISA in parallel makes the most sense because the pension wins on the tax relief, going in while the ISA wins on flexibility and the ability to access money before retirement age if your plans change. And fifth, if you are in your 40s or 50s and you have not done a comprehensive pension review in the last 2 or 3 years, this is the moment to do it. The state pension age rising to 67, the very real possibility of it rising to 68 by 2037, and the long-term question marks over the triple lock all change the calculation for how long your private savings need to last and how soon you need them to be ready. The earlier you understand your real position, the more options you have, and the lower the monthly contributions needed to close any gap, because time and compound growth are the most powerful forces available to any pension saver. The state pension will always play some role in UK retirement income, but the changes of 2026 make it clearer than ever that it cannot be the plan. It can only be the foundation. The Brits who retire comfortably in the decades ahead will be the ones who understood this early, took it seriously, and built their own retirement income on top of whatever the state pension provides, rather than the ones who assumed the government would take care of it and discovered too late. That £12,500 a year does not go as far as they thought. If this opened your eyes to something important, hit the like button and subscribe to the channel so you never miss a video like this one. Thanks for watching, and I will see you in the next one.